All the best. Yes, friends. Everybody, good morning. Yeah, happy Monday. Very, very happy Monday. Departmental accounts. Friends, please stop talking. Settle down. Okay. Like branch, department is also one of the business expansion activity. In this chapter, what we are learning is preparation of departmental final accounts, trading P&L. It is to find out the profit or loss of each and every department. It is for finding profit or loss of each and every department. Okay. In finding out the profit or loss of each department, the uniqueness are two in numbers only. In the preparation of final accounts, there are two uniqueness. One, apportionment of common costs. Other one is unrealized profit arising from interdepartmental transfers. Through this, we are learning how to account for interdepartmental transfers. What is the impact of interdepartmental transfer? Elimination of unrealized profit. Unrealized profit shall be eliminated only from the general trading and P&L, not in the departmental trading and P&L. But there are times where department management's remuneration is based on departmental profit. We reduce the remuneration from concerned department, which is the transferor department. Everybody, like that we have done problems, adequate problems. Now we have two special problems pending. We have already solved 6 questions. 2 questions pending. Let us quickly complete those 2 problems. And let us take question number 4. Question number 4, page number 130. Let me read out this question for you. X Limited has 2 departments, A and B. From the following particulars, prepare the consolidated trading account and departmental trading account for the year ending 31st December 2014. Opening stock at cost, purchases, sales, wages, so one thing is certain realignment should be made. So please do take that. Opening stock at cost 20,000 and 12,000. Purchases 92,000 and 68,000. Sales 1,40,000 and 1,12,000. Wages 12,000 and 8,000. Carriage 2,000 and 2,000. Closing stock. Purchased goods 4,500 and 6,000. Finished goods 24,000 and 14,000. Then purchased goods transferred by B to A 10,000 and A to B 8,000. Purchased goods transferred by B to A is shown in the A's column and A to B in the B's column. Finished goods transferred by A to B 35,000. That's correct. In B's column it is 35,000. B to A it is 40,000. Listen friends, A to B 35,000. Receiver's place the amount is shown, correct? And B to A it is 40,000. Return of finished goods A to B at receiver's place it is 10,000 and B to A it is 7,000. That's all. You are informed that purchase goods have been transferred mutually at the respective departmental purchase cost and finished goods at departmental market price, and that 20% of the finished stock closing at each department represented finished goods received from the other department. This is the information. The requirement of the question they have made very clearly. Prepare the consolidated trading account and departmental trading account from the overall business trading account as well as departmental trading account. This is the requirement of the question. Everybody, please respond friends. There is a company that is having, directly taking for discussion, there is a company X Limited having two departments, Department A, Department B. These departments deals with two types of goods. One is called the purchased goods, other one is called, rather than that, it is raw material and each department buy some goods which is called purchased goods, correct? They process some goods which is ready for sale, it is called finished goods. Like that they are dealing in two types of goods. One is called purchased goods, other one is called finished goods. Everybody please respond. Now these goods are transferred between the departments. It has been informed that purchased goods have been transferred at the departmental cost. I buy for 10, transfer at I buy 10 and process the goods, then it is called finished goods. Whose cost, imagine 20, I may not transfer at 20, it is transferred at a margin. Respond. Please respond friends. So we have two types of transfers, two departments dealing in two types of goods. One is called purchased goods, other one is called purchased goods will be transferred by one department to another department at. Everybody please respond. One department transferring the goods to another department, purchased goods means at, and the other goods which is the finished goods at margin. It is given at the respective market price, correct? Respond. The requirement is prepare consolidated trading and. Now for preparing consolidated trading, you will prepare the consolidated trading like this: opening stock of company as a whole, correct? Purchases of company as a whole, then you will have sales, closing stock and other direct expenses, correct? No P&L account required. What is required is only trading account. So it's opening stock, purchase, direct expense like wages and carriage, and sales and closing stock, you will get profit. Now interdepartmental transfer is not going to appear in the consolidated trading account. It is not a revenue or cost for the business as a whole. Understood? So it will be simply like we prepare for head office branch only. For head office, when it is transferring goods, for them it is revenue. Branch receiving the goods, cost. But overall business, no revenue, no cost. So all these interdepartmental transfer will not appear in consolidated trading account. And moreover, the stock that should be taken in the consolidated trading account should be at a dash price, cost price. Understood? But these information given that finished goods of each department will have transfer made from. Finished goods of each department will have transfer made from, which is at a margin, so that has to be eliminated. Are you following this? So overall, when you prepare consolidated trading account, you should convert the stock at market price into stock at cost price. For that you require margin. In this question, margin is missing. So the 20% given, 20% is very easy information. In one of the question, we found out in a particular department, you will have two components of cost, own cost transfer in cost. 55%, 45%. Do you remember the numbers? Like that we found out 22,000, 18,000, 40,000 current day production, 55%, 45%, we found out the mix. In this question, they themselves are telling that out of the goods in a particular department, 20% of the goods are transferred from 20% of the goods are transferred from on the entire closing stock. You need not apply the margin because I have my own cost which does not have any markup. Markup is there only for the goods transferred from the. So that 20% of my goods represent transfer made from other department. Similarly, 20% of their goods are transfer made from our department. Do you appreciate that? So only item missing is margin, gross profit margin, correct? Which we can easily find out by preparing departmental trading account. By preparing, that is the first part of the solution will be prepare departmental trading, find out gross profit and find out gross profit using the margin, convert the closing stock into cost price and then prepare the consolidated trading account. Could you appreciate that? This is the approach of the solution. First you are going to prepare. When you prepare departmental trading, same like only normal trading, opening stock, purchase, sales, closing stock. Apart from that, you also have interdepartmental transfers. Transferor will credit and transferee will debit. That's all. Understood? Whether it is purchased goods or finished goods or returns, whatever be the case, a department which is transferring will be crediting the trading account. A department which is receiving the goods will be debiting the trading account. Could you appreciate that? So with that points in your mind, why don't you try departmental trading account quickly? Please prepare. Pen kudu. Group 1 என்ன மார்க் வந்திருக்கு? பேப்பர் கொடுப்பாங்க, கரெக்ஷன்லாம் பண்ண மாட்டாங்க. நிச்சயம் பண்ண முடியாது. அதான் ரீவேலிடேஷன் பண்ணலாம், ஆனால் பேப்பர் வாங்கிட்டீங்கன்னா ரீவேலிடேஷன் அதை வச்சு பண்ண முடியாது. ஆமாம். ஆல் தி பெஸ்ட். Okay, so let us understand that to opening stock, this is given as at cost, means it is the purchased goods, so they don't have finished goods on the opening day, so there is something called opening stock reserve. So it is 20,000, 12,000. Then we have purchases. Purchases 92,000, 68,000. By sales 1,40,000, 1,12,000. Then to wages 12,000. To carriage 2,000, 2,000. Closing stock purchased goods, how much? 4,500, 6,000. 24,000. Okay. So then purchase goods, transfer. So buy, transfer out. Purchased goods. B to A means B credit pa. How much? 10,000. A to B means A credit. 8,000. to transfer in purchased goods 10,000, 8,000. Transferor will credit and transferee will debit. It's a simple concept here we are following. Understood, Abba? Next. Finished goods. Finished goods. It is A to B. So A credit 35,000. B to A 40,000. Finished goods 40,000. 35,000. Then return of finished goods. By return out. What goods? Finished goods. A to B 10,000. B to A 2 returns in. Gross profit. 38,500. That's correct. $38,500, 46,000. Can I turn this page? Can I turn this page? Friends, please listen, friends. Gross profit ratio. Now here in the consolidated trading account, we will have opening stock. Opening stock 32,000. Purchases 1,60,000. By sales 2,52,000. To wages 10,000. By closing stock, purchased goods, finished goods, working note number 2. Everybody. And then you will be getting the gross profit. No other transaction will be accounted. Interdepartmental transfers, the returns, all these things will not come in the consolidated trading account. So only the direct transaction made by the branch department with the outsiders. Understood? Now for this, finding finished goods, the stock minus stock reserve is the cost price. This is presently a loaded price. These are all representing at their internally booked profits. So we want to eliminate that internally booked profit. Shall we proceed? For which I want to know what is the margin of A and what is the margin of B for fixing selling price. So let us identify one by one. Can you tell me GPR of A, GPR of B? GPR of A, GPR of B, 27. Okay. 41 point. What do you mean by gross profit ratio, friends? Gross profit by sales into 100. Which means the sales is the amount on which the gross profit was earned. Respond, friends. This profit of 38,500 is the profit earned on some amount, correct? That is how we are getting the margin. Clear? You should be knowing one thing. This profit is not the profit earned only on the sales to external customers. It is also made on the profit on transfers. Are you following? So thereby this GP is not the ratio that you should compute only on external sales, but also on internal transfers. But internal transfer of purchase goods happen only at cost price. So purchase for 10, transfer at 10. That does not generate any profit. Please respond, friends. Only the transfer of finished good generated profit. Could you appreciate that? So thereby this profit has been earned on 1,40,000 as well as on the transfer of 35,000 minus 7,000. Minus, because it is the return of the finished goods. Could you appreciate that? So this is the sales made, this is the returns in, sales returns should be considered. Could you appreciate that? So that will be 1,40,000 plus 35, 175 minus on 1,68,000 only you should find out gross profit ratio. So thereby you find sales external 1,40,000 1,12,000 transfer of finished goods 35,000 return of finished goods 7,000 1 lakh, okay, 1 lakh, gross profit was how much? 38. So GPR equal to 38,500 by 1,68,000 into 100. 22.91 or 92. And here it is 46,000 divided by 1,42,000 into 100 percentage. This is the gross profit ratio. So the profit is earned not only on external sales but also on internal transfer, because internal transfer was also at market price. So thereby, and return of finished goods was reduced, arriving at net sales. GP is on net sales and not on gross sales. So that way we got the GPR as 22.92% and 32.39%. Can you turn this page? Okay. Listen friends, stock reserve of Department A. Can you arrive at the stock reserve of Department A? What is the stock included in finished goods? So what is the finished goods, my dear friends, of Department A? 20. This 24,000 stock of Department A was fully transferred from B? No. It has got own cost and transfer in cost. So thereby, out of 24,000, it's given that only 20% was transferred from other department. Everybody respond. So into. That's very nice. Please understand. Here what you should be very careful now. I should not apply 22.92%. I should apply 32.39%. Why, sir? Exactly, because in A stock we are finding what is the stock of B included in A stock, correct? So thereby naturally we should be taking the margin of governing A. So thereby it is closing stock into the percentage of the stock held by the other department into 32.39%. How much is it? 1,555. Are you following this? Now in that case, what is the closing stock? Finished goods of Department A at cost will be what, sir? 24,000 minus 1,555. 22,445. Do you understand, friends? Similarly, let us find out stock reserve of Department B. 14,000 into 20% into 22.92%. 642. So finished goods at cost price 14,000 minus 642. 358. Everybody. Now, what is the total closing stock? Total finished goods 22,445 plus 13,358. 35,803. So which will be taken in the consolidated trading? 35,000. What is the profit? 82,303. My dear friends, this 82,303 we can cross verify. What is this profit? Plus, these are the profits of two departments. From this, if we can reduce the unrealized profits, 38,500 plus 46,000 is 84,500. 84,500 minus unrealized profit, which is 1,555 and 642. If you reduce that, it should be equal to 82,303. Understood, Appa? This is the overall profit of the business. Is that clear, friends? Everybody? Now quickly take down. And in fact, you would have completed. This page, anybody copying? Question number 3, last question. Friends, please settle down. Over. Friends, please stop talking. Okay. Shall we? Cost price of a particular unit of goods, 300 rupees. Profit is 100. Selling price is 400. Very elementary question. Gross profit ratio. Gross profit ratio equal to 20. Gross profit by sales into 100. That is 100 by 400 into 100 25%. So once the ratio is determined, this ratio remains the same for any number of units. Please respond. Now, once the ratio is found out for 1 unit, the same ratio can be extended for any number of units. Now I am telling sales 12 lakhs. Profit can be easily determined without knowing the number of units sold, without knowing the cost price, without knowing any other information. You can easily find out the profit. So what is profit henceforth? Sales into GPR. Respond. Once GPR no one information is determined, once GPR no one information is known, always profit equal to sales into GPR. Sir, these are all so fundamental, sir. Don't tell these and insult us. I understand that. I'm not insulting, just confirming my knowledge. Correct? So we understand once the GPR is found out, then we can find out the profit by applying the profit ratio on sales always. Correct? Please respond, friends. Everybody?
Yes, sir.
Now what happened? Sales 12 lakhs means profit. Sales 15,000. 3,750. Sales 24,000. 6,000. Everybody. Now listen, friends. What happens is that this enterprise making sales like this, it is selling 1,000 units. It is selling 800 units sold for rupees 400. 200 units sold at a discount of 50 rupees. At a discount of 50 rupees. Understood, Abba? Or say 40 rupees. 200 units sold at a discount of 40, which means 360. Correct, Abba? Discount 40. So what is the sales here? 800 into 400. So this business enterprise which reported this information below this hand reports a sale of 3,92,000. Correct, Appa? Respond. What is the profit? 92,000. What is the profit here? Gross profit. What is the ratio, my dear friends? What is the ratio? 25%. Correct, Abba? And it is reporting a profit of 3,92,000, no? So what is that? Amount comes to 90. How do you got this? 3,92,000 into 25%. Like this if you do, that's wrong. We know it's wrong. Profit is how much, pa? 83,200. It is 92,000. Now listen, how I know 92,000? Because I know cost is 300. How many units sold? Please respond for it. 1,000 into 300, 3 lakhs. 1,000 into 300, sale value. Profit naturally. Sir, but all this time we applied GPR. Sales into GPR is profit. Everybody. So you said you don't know this information. If you don't know this information, then how do I find out the profit here? That's a question. Are you following? Please respond. Do you follow the discussion, my dear friends? A business which is giving its GPR as and business reporting the sales information alone doesn't report any of the information about cost, selling price, all these things. Correct, Appa? Business reports only the sales information, 3,92,000. Please respond. And it provides a breakup of sales. Now we know. See, if I know this information, I know profit is 92,000. Why 92? Because cost of 1 unit is 300. 1,000 units sold, 1,000 into 300, 3 lakhs. Understood, our friends? Everybody? Yes, sir. Now the actual profit is 92,000. First agree that? Yes, you understood that? Yes, now how to arrive at 92,000? With the help of gross profit ratio. Without knowing this cost price and other breakups. Could you appreciate that? So only information given in the question is that 1000 units sold. Respond. Or not even 1000 units. Not even 1000 units. Sales 3,92,000. Sales. During the year, 200 units were sold at a discount of rupees 40. That's the only information given in the question. Are you following? Respond pa. No other information given. So what are the information given? Sales. How much? 3,92,000. Then also one note, including sale of 200 units for how much units for at a discount of rupees 40. In such cases, my dear friends, to get 92,000, what we should do? GPR is also given as 20. These three information given. With this three information, I want to find out the true gross profit. Shall we? How to find out? Now, this gross profit ratio cannot be applied on 3,92,000. If you apply, it will give you a wrong gross profit. Correct? Please respond. Respond, pa. The gross profit ratio can be applied only if all the goods are sold at the predetermined selling price. If there is some concession or some abnormal increase in selling price, definitely this ratio is not true. So thereby, now listen, actual sales was 3,92,000. Correct? Respond. Had all the sales took place at normal selling price, can you apply this gross profit ratio? Yes, everybody? Yes, now in that case, actual sales 3,92,000 plus reduction. The reduction that has been already made. What was reduction made? 200 unit into 40 rupees. 8,000 was the reduction. Correct? Please respond. So my sales is how much? I am finding the sales. If there was no reduction, how much would have been the sales? Are you following? And my sales is how much? Now GP at the rate of 25%, 1 lakh. Which means I am telling, if I have sold the goods without reduction, the sales will be 4 lakhs. And the profit will be 1 lakh. But there was reduction. Such reduction actually reduces our profit. So minus the reduction. That is discount. How much? 8,000. And the profit is 92,000. So what we have learned through this discussion is that when a gross profit ratio given, everybody, sales given, usually gross profit equal to sales into gross profit ratio. Do you remember that? Understand that? But if the sales is not happening at that original selling price, this ratio cannot be applied. But if you want to apply the ratio, no other choice, I don't have any other information, no other choice and no cost, nothing. Then what I can do is bring the sales to the original selling price. Whatever concession, reduction already happened, you add back. Bring the sales as if the sales happened without concession. Apply the gross profit ratio. You will get the gross profit minus the reduction. Please respond, friends. So once again, how to find out gross profit amount in case of concession? That's okay. So in case of concession, reduction, discount has been offered, then gross profit will be found out this way. It is actual sales. Add back the reduction, you will be getting the sales without reduction, then apply the gross profit ratio, you get gross profit minus reduction, you will get the true gross profit amount. Otherwise what happened? You are getting a wrong gross profit of 98,000, which is not correct. This technique we are going to apply in this problem. That is why instead of after reading the problem explaining, so we thought of discussing this before we solve such problem. Shall we? Now I will tell you the background behind such concept. Like we had a head office accounting The head office making accounts for the branches. In departmental concept also, in departmental wise also we find there will be a centralized office which makes the purchases, which will send the goods to various departments. Instead of department directly purchasing, the centralized department of accounts and the operation will make the purchases and will send goods to the departments. Please respond, friends. Instead of the accounting records happening at the departments, the accounts will be kept at the centralized department by maintaining two accounts, two control accounts. One is the stock account, the other one is the profit account. Stock and profit. In branch we are calling this branch stock, branch adjustment. Various other accounts we open, but here we don't open many accounts. There are two accounts we open, everybody. What are those two accounts means? One account we call as memorandum stock account. What stock? And the another account is called memorandum markup account. What account? Like branch adjustment, this is called memorandum markup account. Everybody, that way we have two accounts. One is called memorandum stock, the other one is memorandum markup. Now what we will do is that when the goods are sent by the centralized office to the, when the goods are sent by the centralized office to the departments, then this centralized office will debit the memorandum stock, will debit the, as and when the stock is in department, as and when the stock is increasing at the department, as and when the stock is increasing at the department, stock account will be debited. Who will debit? Department, the centralized office. Could you appreciate that? Debit the stock account, and credit will be offered to purchases. Credit will be offered to? Why credit is offered to purchases, sir? Because when the goods were originally purchased by this centralized office, the entry was purchased to cash. When the goods were originally purchased, entry was, now that purchased goods only we are sending to department. Purchased goods only we are sending to department. Are you following this? In that case, we debit stock account. We debit credit at cost price, but debit stock at selling price. Debit stock at credit at, the profit will be booked in a special account called markup account. The profit is not getting booked when the goods are actually sold. When the goods are sent by the office to the, profit is booked. For same concept what we discussed under stock and data system. Please respond, friends. So this office sending goods to the, this office maintains account. Now stock is increasing at department, purchase is getting nullified, and the profit is booked in a separate account called memorandum markup account. Could you appreciate that? Please respond, friends. As and when the goods are sold, sales alone will be credited to the stock account. Sales will be, the debit entries in the stock is a dash price. In the stock account, the entry is at dash price. Selling price, memorandum stock you debited, no, not at cost price but at memorandum stock debit at selling price to purchases, cost price to memorandum mark. What is entry in branch? Branch stock at invoice price. Two goods sent to branch. It is literally purchases only at cost price. To branch adjustment profit. Same entry. Instead of branch stock, memorandum stock. Instead of branch adjustment, memorandum markup account. Could you appreciate that? As and when the goods are sold, the sales will be credited to the stock account. It will be credited to the note. At that time, profit will not be booked. Correct, Abba? When the goods are not, when the goods are not, then we will reduce the profit. Then we will reduce the profit. We will arrange stock in the stock account which represent dash price. Selling price. Immediately we remove the profit. Correct? It is not transferred to stock reserve, it is carry forward to next year. It is carry forward to. Even in branch adjustment also we have seen, instead of creating stock reserve, we can use by balance brought down to balance carried down. Could you appreciate that? So we are booking the profit when we are sending the goods, not when selling the goods. At the end of the year, when the goods are not, the profit will identify, we carry forward to the balance profit is the profit relating to which will be transferred to general P&L account. Well, following this is a specialized accounting followed in case of certain departments. Understood? Following memorandum stock account and memorandum markup. Understood, friends? So when goods are purchased to cash by that office, that we are not going to make. Relating to this, when the purchased goods are transferred, then memorandum stock at to purchases to markup. Sales will be credited to memorandum stock account. But suppose the goods were lost. Then the loss has to be separately booked. Respond. Entry will be abnormal loss debit. Then memorandum markup account debit. Memorandum to memorandum stock account. What is the entry for loss of stock? Abnormal loss debit. Memorandum. Why we should debit memorandum markup? Because we already booked profit. Now we know that profit is not recoverable. So we debit the loss of stock at cost price, abnormal loss, markup account debit to memorandum stock. Credit memorandum stock at selling price or cost price? Selling price. Because debit was made at, we should remove the stock at selling price. Could you appreciate that? Please respond. Similarly, one department transferring to another department. What we should do now, we should not account like as if A transferring to B, it will be accounted as if it was taken back from the department and it is sent to the other department. Could you appreciate that? Please respond. When they have given A transferring to B, respond pa. They will give the cost price of that goods. Now when we use the entries, it will be taken back from the stock of A, it will be transferred to the stock of B. Please respond pa. We may take out from the stock of department A at a particular margin, but not necessarily same amount only transferred to B, because for B it may be a different margin. So you should not feel that it is A transferring to B at a A's margin and all. It is purely centralized office removing the transaction originally recorded. They have already sent the goods to department A. At that time some debit was made. Now the removal will be made at the original margin of A. Now goods will be recorded in B stock at the margin of B. You should not say that A only transferring. No sir, A's margin only should be recorded. Like that concept will never arise. Correct, Appa? Whenever there is a centralized office, there is no concept of A transferring to B. It will be removed from A and transferred to B. All these things we can appreciate only through the special problem. Understood? Everybody? Now let us take this particular question. It's an attempt before the examination. The last examination, you have to come in the examination. The main examination. Generally, very remotely it used to come. So far twice this type of problem has appeared. This type of problem means there is only one type with the numbers change, only it can come. So it's remote, but still we would like to try that. We don't want to take any chance. Understood? Right? It's a little complicated computation area. One relating to this finding of gross profit whenever there is a reduction. I'll tell you what reduction also. We have sent the goods at dash price. Selling price with a profit already booked in what account? Markup account. Now, because of competition that we are facing, we will reduce the selling price of the goods. We will reduce the. In that case, this centralized office will make a reversal entry. What entry means? Markup debit to memorandum stock account. What is the entry? Markup debit to memorandum stock. Suppose 100 rupees goods was transferred at 150. What is the entry? Stock debit 150. To purchases 100. To markup 50. Now later on we are telling sell goods for 140 only. Not at the time of sales we are reducing. We are making an instruction to them that will be accounted. Understood? Sell goods for 140 now. All the goods which are already sent at 150 has to be brought to 140. Reduce stock by 10 rupees as well as profit by 10 rupees. Not when the goods are actually sold. When the event of reduction happening, which we call it as marking down. Event of marking down is the event of reducing selling price. Are you following? Suddenly some function comes, some competition is happening between the competitors. We'll make 5 rupees off. Understood? So those events at that time we will reduce the stock as well as the profit which is already booked. Could you appreciate that? Anyway, all this discussion will put into the form of a problem. Question number 3, page number 128. No, not required, not required. Pioneer Limited, a retail store, has 2 departments for each of which a memorandum stock account and a memorandum markup account are kept. All goods supplied to each department are debited to memorandum stock account of the department at cost plus a markup which together represent normal selling price, to which account the sales of the department are credited. The markup is credited to the department markup account. If the selling price of any goods is reduced below the normal selling price, the reduction called markdown is entered in stock account and in the markup account. The markup for A is 33 1/3% of cost and for B 50% of cost. The following figures relating to the year 2013, 2014 have been taken from the books. Department A, Department B. Opening stock, purchases, sales. The stock of Department A on 1st January included goods which cost rupees 2,700. The selling price of which had been marked down by rupees 250. These goods were sold during 2014 at the reduced prices. Goods purchased in 2014 at a cost of 1,440 for Department A were later in the year transferred to Department B for rupees 2,160. The cost and sale proceeds are included respectively in the purchase of Department A and the sale of Department B given above, but no entries for the transfer have been made in the books. Some items of the goods purchased in 2014 were marked down as follows. Department A, Department B, cost and markdown given. With the exception of certain items of stock in Department B at the end of the year which cost rupees 5,000 and were marked down by rupees 1,000, all goods marked down in 2014 were sold during the year at the reduced prices. At the stock taking on 31st December 2014, it was found that the goods which had cost rupees 120 were missing from Department A, and it was decided to regard this amount as irrecoverable and to show the loss separately in the profit and loss account. For the purpose of annual accounts, the closing stock of both the department is to be valued at cost. You are required to prepare in columnar form for each department for the year 2014 trading account, memorandum stock account and memorandum markup account. First we will prepare the trading account of these departments, shall we? Now let us quickly give you the facts of the problem. There is a company called Pioneer Limited which is having 2 departments, Department A and Department. The paragraph starting like this, all goods are supplied to each department till ending that 50% on cost. All these things are explanation which is already made so far. So don't think that there is something more to be explained. There is nothing involved in facts or numbers of the question. This is just the accounting method so far that we explained. Maybe we'll read once again. All the goods supplied to each department are debited to. When the goods are transferred to each department, it is debited to of the department at cost plus a, which means it is debited only at which represent normal selling price, to which account the sales of the department are credited. Whenever the goods are sold, it will be credited in stock account. When the goods are sent, it is debited to stock account. Respond. The markup is credited to the department markup account. Whatever profit margin we are adding, will be shown in a separate head called markup account. If the selling price of the goods is reduced below the normal, the reduction markdown is entered in stock account and markup account. When it is marked down, then we will reduce both stock as well as markup account. Then they have given the markup information. Everybody, please respond. Yes. Then they have given opening stock, Purchase, sales of various departments. Shall we proceed? Then they have given information about a markdown that had happened during the year. These goods were sold at the reduced price. During the year, goods costing 1,440 was later transferred to Department B. Correct, appa? For rupees 2,160. Should not be misunderstood that it is A's profit. Centralized office only booking the profit of both A as well as. So it will be removed from the stock of and it will be put as stock of which will be recorded as sales for B at 2,160. Could you appreciate that? If you look into the margin of B, it is 50% above cost. So it is actually 2,160 because 1,440 plus 50% margin. Could you appreciate that? Please respond. It is not the profit of department A, my dear. It is the profit of department B. It will be removed from the stock of A and will be booked as stock of and B sales will be having the such amount. But we need not do anything because the cost and sale proceeds are included respectively in the purchase of department, which means in this purchases that amount is included. Only thing is we should be removing that goods from this purchases. Correct? Please respond. Then it is included in the sales of department. It is included in the sales of department. What we should do now, the cost which is included in the purchase of should be reduced from the purchase of and should be recorded as cost of B because it is supposed to be the profit of B. Once again, it is not A's profit, my dear friends. When there is a centralized office, now you should not take the past lessons what you have learned. This is a very special type of accounting where a centralized office transferring goods to A book the profit. When the goods are transferred from A to, it will be removed from A's accounts. In our place only, not in A will account all these things. Correct? In our place only, it will be removed from A's account, will be booked as B's account. Could you appreciate that? Please respond. Now already it is included in A's cost, B sales. Now what we should do now, including in B sales is correct. Only thing is it should be removed from and it should be included as B's cost. That's all. Are you following this? Anyway, we like to put that in writing. And then there is also, but no entries for the transfer have been made in the books which we will be making. Then some reduction happening during the year. All these things reductions are relevant for our computation of gross profit ratio. At stock taking on 31st December 2014, it is found that the goods which had cost rupees 120 were missing from the and it was decided to regard this amount as irrecoverable and show the loss separately in the profit and loss account. Are you following? In this place they are not asking the profit and loss account or not, they are asking only what? Trading account. Shall we proceed? So let us prepare the trading account. Shall we? Everybody? Friends, please listen. Let us now prepare department trading account. In the department trading account, the first part of the solution. Friends, please keep quiet. To opening stock. $12,000. Two purchases. 81, 94. Now listen friends, in this 81,600, the goods transferred from A to B is included, na? That should be removed from this A by transfer 1440 should be booked here as to transfer. No, it is 1440. Now the sale value, it is not A to B, my dear friends. It is the profit of B which is already included in the sales of B. By sales, what is the sales? 1,05,000, 1,40,000. In this 1,40,000, 2160 is already included. Now by recording the cost for B 1440 and sales for B 2160, B will book the profit of 50% above the cost. Now the 1,440 which was included in the purchase of A was removed from A and will be booked as cost of B. This is not transfer like what we discussed earlier. It is not two different departments accounting their own transaction. It is not A's profit. It is B's profit. Could you appreciate that? So that is the point it is conveyed there. It is unlike the past practice what we learned, where department have their own accounts. This is purely and centralized office accounts which was initially recording. Now listen friends. 1,440 which has been recorded as cost of department A, including the sales of B. The transfer alone not made, we will like to transfer it. Understood, Appa? Either reduce here itself and add to B's cost, or make it as a separate event and record it, eliminate it and record it. Could you appreciate that? So here we will not record that loaded price. Could you appreciate that? It is not A's margin booked by A. It is a centralized office only booking margin for A as well as B. Could you appreciate that? Please respond. Now, apart from these transactions, we also have abnormal loss. Abnormal loss gets eliminated from the trading account to the extent of 120 for department A. Then closing stock. What is the closing stock information given? What is the closing stock information given? Now it's a lunchbox opening, yeah? Over. The sound shows everything is over. Paal kudichiya. Anyway, please, don't make noise. Two, friends, closing stock in this question is not there. So which will be arrived as balancing figure. What you should find out is the gross profit. Gross profit ratio is given in the question. Please respond, friends. Sales into gross profit ratio will give you gross profit amount. Yes. But if there is any concession, then you know a technique. Correct? There are two types of reduction that had happened. Reduction on the opening stock. Reduction on the goods purchased during the current year. So why you didn't do such reduction here and all? See, such reduction happening in the sales value. Correct, Appa? Now you should find out the gross profit by considering such reduction, for which information given from this second paragraph, and in the last paragraph also reduction information is given. Understood? I want you to arrive at gross profit amount. gross profit 27, both the company, both the department. Twenty-seven, 383, 50. 25, okay, 33, 26 to 50, 46, 25, 44, 'Now listen friends, sales given, how much? 1 lakh, 1,46,000, correct? Plus reduction, everybody, on opening stock, current year purchases. In the opening stock, in Department A alone, there is a reduction to the extent of 250, not for B. For the current year purchased goods, table is given. For Department A, 400 and no, not 4,860, 430. The goods costing 4,860. That is irrelevant for us. What is the markdown? 430. For B, 1,000. So you asked me how 1,41,000 came. Now listen. Hey, sure, listen. Settle down. Okay. So please understand, we are finding out this gross profit ratio. Gross profit ratio we are finding. No sir, sir mala podu kuda pichu kuda. Ena sambandhame kedaidu. So now listen, for department A and department B, listen here friends. When we learn the concept, when we learn this concept of finding gross profit, whenever there is reduction, we learn like this. Actual sales, whatever reduction that has been offered should be added back. Everybody? Now the markdown is not something happening at the event of sales, my dear friends. It's a event, that markdown, instructions to reduce the goods at a price lower than the normal selling price, correct? Please respond. Doesn't mean that when the selling price is reduced, all such goods whose selling price is reduced has been already sold. Whatever goods on which selling price has been reduced, not necessary that such goods should have been sold. Are you following us? Please respond. So only if in the sales that reduced or reduction is included, that only can be reversed. Not the entire reduction we can reverse. Sir, when do we offer concession? At the time of sales? No, that is what I am telling. Please understand, my dear friends. Centralized office sending goods to department at a selling price, we are recording the profits, correct Abba? Later on, we are telling selling price be reduced by this much amount. Respond. Then on whatever goods the selling price is reduced, not necessarily all such goods should have been sold in the current year. Understood Abba? So thereby what happened in this question? They are telling that there were reduction on the opening stock by how much pa? And on the current year purchase 430 and with the exception of certain items in stock in department B, at the end of the year whose cost is 5,000 and were marked down by rupees, all the goods marked down in 2014 were sold during the year at the reduced prices. Similarly, they also told that on the opening stock there was marked down by, these goods were sold during 2014 at the reduced prices, which means the reduction of 250 is included in the current year sales. The reduction of 430 is included in the current year sales. Out of reduction of 2000, what is included in the current year sale is only 1000.
Yes, sir.
Remaining 1000, whatever you reduce is still there in the closing stock. Please respond, friends. Everybody. So thereby we need to understand that we are adding back only the reduction included in sales. Understood? In selling this amount, there was reduction happen only to the extent of 1000. Understood? Please respond. So that way it is 1,05,680 and 1,41,000. Gross profit ratio on cost given as 33 1 by 3 percentage, that is 1 by 3, and here that is 1 by gross profit on sales 1 by 4, 1 by 3. Everybody, this is the sales at normal selling price. Everybody, so gross profit at normal selling price equal to 1,05,680 into 1 by 4. 26,420. 1,41,000 into 1 by 3. 47. This will be our profit had we sold at a normal selling price. Did we offer some concession? Then that much profit we could not get. So that reduction, concession should be reduced. Could you appreciate that? So reduction, marked down 680 and 1,000. What is this? 25, 740, 46,000. This is the gross profit that should be recorded. So gross profit 25,740, 46,000 Closing stock 13,080. Yeah. 13080 and 19,640 is the balancing figure. Quickly take down. This page over.
Yes, sir.
2. Next page, friends. Have you written this, completed this page? One lakh 5,680 into 1 by 4. 4 then. 3. Let me turn this page. Friends, the concession offered during the year is an event instruction made by the office to the departments. So it has already conveyed the reduction on opening stock of 250 and on the current year goods by 430. For department B, there is a reduction by 2000. So when such reduction exists, we added back the reduction. And when we added back, confusion comes. Here you are adding all the reductions, sir. Here when the reduction conveyed in the question is 2000 and you take only 1000. Why, sir? Because out of the reduction happened on some X quantity of goods, certain goods whose value was reduced was not sold. Remaining goods only sold. Which means in the sales of 1,40,000, there is a reduction of only 1,000 rupees. In this reduction, in the sales of 1,40,000, there is a reduction only by remaining reduced price will get sold in the next year. Until such time it is there in our closing stock. Following that point only you should be knowing. Based on that ground, we computed. First added back the reduction, brought the sales to normal selling price, applied the respective margin. We got GP at normal selling price, reduce the reduction, we got the gross profit, correct? Respond. Now listen, friends, preparing memorandum stock account and memorandum trading account. Mark up account. Memorandum stock account, memorandum stock account for department A, for department B. Department A, department B. Memorandum, markup account. Department A, department B. Department A, department B. Friends, please. Okay. Now memorandum stock account and memorandum markup account. Now bring to that mode of posting. When we transfer the goods, debit the stock at dash price. Entry is memorandum stock debit to purchase to markup, and markup will be taken here in the credit side. Correct? Sales will be simply credited. Respond. When the stock is transferred from A to B, whatever we already transferred in will be removed and will be transferred to B. Understood? Now let us take one by one, friends. It is like this. To balance brought down. To balance brought down. Now listen. To balance brought down. For A, 12,300 plus 1 by 3 minus 250. Do you understand the computation? Yes. Sir, why do you do all this computation, my dear sir? Because it is recorded dash price, selling price, and the margin for A on cost is 1 by 3. But then why do you reduce 250? It is already reduced. On opening stock, there was a reduction of how much, friends? 250. Correct? So thereby the selling price of opening stock of department A is how much? 16,150. For department B it is 17 plus 1 by 2. 26,100. Understood? Immediately profit will be there. By balance brought down. By balance brought down. It is 16,150 minus 12,300. 3,850. 8,700. 16,150 minus 12,300 and 26,100 minus 17,400. We already booked the profit. Correct? Profit is not booked at the time of sale. Profit is already booked. Correct? Please respond. Now let us account the first event, purchases for A and B separately. Understood? So what is the entry for purchase for A and B? First already purchase was made. That will be given to the A and B department. 2. Purchases to markup account. Purchases. No. 81,600 and markup is 27,200 and here 94,800, 47,400. Purchase is the actual purchase, that is not having the markup and all. So now we will be recording the markup by memorandum stock. Profit on the purchased goods transferred to the department during the current year. How much profit? 27,200 47,400. We sent goods, everybody. Sales will be simply credited. No other entry for this. Sales will be simply credited in stock. At that time we don't book any profit. 1,05,000, 1,40,000. The other events are marking down the reduction that had happened during the year. What is the entry? By markup account. What is the reduction during the year? Means 430 and 2,000. These are the two reductions that had happened during the year. So which will be recorded in the markup account as 2 memorandum stock 430 and 2,000. Then abnormal loss. By abnormal loss, the cost price as well as markup. Because when you want to eliminate these goods from the department A, it has to be removed at the selling price. So which is 120 the cost price, and then we have markup 40. So profit should be removed. Because why we have to remove the profit? Already profit is booked at the time of sending the goods, purchases. Correct? So thereby we should reduce the profit. This debit was relating to markdown. Indicate that. Sir, on opening stock you are not making entry. Opening stock, it is adjusted in the opening stock itself. Only for current year, it's an event of markdown happened. Then 2 memorandum stock for abnormal loss, it is 40. Interdepartmental transfer. It is not A's profit, it is removed from A's stock. Respond. By transfer 1,400 and by markup. Profit should be removed. How much? 480. It is not 720. Please realize the fact that this is actually eliminated from A's debit. It was booked in the A's debit at what margin? 1/3. Correct? Same margin only will be applied. It is not 1440 A transferring to B. It's a centralized office receiving the goods from A and transferring to B at B's margin. Could you appreciate that? So it has to be removed from A at 1920. Correct? Respond. It will be booked in B to transfer in B 1,440 to markup. How much, friends? 720. Sir, it is not matching, like that don't tell. It is not A transferring to B. It is that the department which are recorded debit for A, removing from A. Recording in the debit of B. That is what you should be knowing. Understood, Abba? Now, such profit should be removed from A to memorandum stock. Transfer. How much profit removed? 480. Then by memorandum stock. Because of transfer for B, how much? 720. Now all the transactions got accounted. Everybody? Now can you arrive at the closing stock balancing figure? By balance carry down. Just balancing figure. 17,440. 10,460. This is the closing stock of the department at dash price. Selling price. Understood? Now, in the profit, you have 2 balance carry down and 2 general P&L. Now listen, friends, rather than copying. 2 balance carry down means profit relating to this closing stock should be carried forward to next year. So what is the profit relating to 17,440? What is the margin included in 17,440? 1/4 or 1/3? 1/4 or 1/3? 1/4, because it is representing what price? Selling price. So what is that 17,440 into 1/4? 4360. Correct, Appa? Now arrive this account as balancing figure. Amount transferred to general P&L. 25? 7? See whether it is matching with the trading account what we prepared. Are we not getting same profit? So if you have any difficulty, if you have completed trading account, that profit you can take here. Are you following? So it is, though I am making in a separate computation, how do you get 4360, my dear friends? 17,440 into 1 by 4. So you can take the profit directly, copy it from trading account, correct? What is the profit then for department B? 40. So that you can arrive at the amount to be carried forward as balancing figure. How much is the balancing figure? No, this amount minus this amount. 88. Because of me working like this, anybody having any doubts to ask? Sir, for department A you told 17,440 into 1 by 4, it matched, sir. Yes, sir. Department B we are copying this 46,000 profit, but this is not matching, sir. Yes, sir. Because we have to apply 1 by 2 or 1 by 3? 1 by 3 we have to apply. For department B we have to apply 1 by 3. But when I apply 1 by 3, sir, it is not matching. Sir, this is correct, huh? Who told 10,460? 28,460 into 1 by 1 by 2 or 1 by 3, yeah? 1 by 3, still not matching. It's because in closing stock there is a reduction of 1,000. So if you want to get the real profit, what you should do, first bring it to the normal selling price. 28,460 plus how much? 29,460 into 1 by 3. 98 minus 1,000. 8820. Are you following? Here that problem is there because I told you out of reduction of 2,000, how much reduced goods were sold? Then remaining 1,000 is still there in which stock? Closing stock. So this closing stock does not represent the normal selling price. This closing stock represents the reduce the selling price, bring it to the normal selling price, apply 1 by 3, reduce at 1,000 again, you will get the 8820. Correct? Or what do you do? Copy the profit from trading account. Alright, this as balancing figure. Anyway, that is studied. Are you following this? It's not so easy to grasp in short period, my dear friends, unless you practice 1 or 2 times. This problem alone, departmental accounting, it is very tough to get a grip over this topic. So 1 or 2 times you have to practice at your place. Understood? So basic computations only we could gain grip in the class. The concepts and all, please solve once again. Definitely you can appreciate that. But do it at the last whenever you find surplus time. Otherwise, there is no necessity. Correct?